Hello everyone, Casey here. We are the Baking Analyst channel, and on this channel, we cover cryptocurrencies, investing, economics, with a focus on yield farming for now. So if that sounds interesting to you, do consider subscribing to the channel and hitting the like button. So today, this video was really meant to be like the banner video of the whole channel, and today we wanted to talk about why we want to even yield farm in the first place. So this video is a case for yield farming. So in case you don't know what yield farming actually is, I actually have a short online course on Skillshare. You can access that with a free trial. The link is in the description below. No cost to you whatsoever and cancel anytime. In this video, we'll be covering some basics of what yield farming does and how you can benefit from it and why you should consider yield farming if you're already into cryptos. So what really is this whole yield farming or liquidity mining thing? Well, yield farming basically involves you providing liquidity in token pairs to a decentralized exchange, and you earn yield or new tokens either through incentivized yield farms, which pay you their farm token for providing liquidity, or from trading fees, which you get when people make trades on the exchange. They might pay 0.2 to 0.3% of their trade value to each trade, and this fee goes towards the liquidity providers. Perhaps we need to first understand how markets work traditionally. So traditionally, liquidity is provided by either a limit order book, where there are buyers and sellers willing to buy or sell at different prices, or by inventory held by the broker. For example, if you were to try to purchase an Apple stock, someone has to be willing to sell it to you. So instead of having this centralized system of trading, a decentralized exchange involves people coming together, providing liquidity in token pairs to an automated market maker. The automated market maker is always willing to buy and sell at any price. And the price is determined, as the name suggests, automatically. So how do people provide liquidity to a decentralized exchange? They basically provide two tokens in equal amounts, let's say Harmony 1 and BTC. And then they pair these tokens and contribute it to a liquidity pool in exchange for LP tokens, which are essentially a receipt for the tokens that they deposited in the liquidity pool. Then they might stake these LP tokens into a farm, and that farm is incentivized, meaning it generates yield, or they earn trading fees, however the tokenomics of the exchange works. So the ratio of token values in each pair must always remain at a 50-50 split. Prices are discovered automatically, because when someone sells, let's say, one coin for another, there's now more of one coin in that pool and less of the other coin that they bought. The automated market maker assumes that the prices of both coins in dollar value must remain the same regardless of how many coins there are in the pool. So if there are fewer of one coin and more of the other coin in the pool, the coin that has a larger supply in the pool has essentially depreciated in value, and that's how prices are determined. So now we want to talk about why you might consider yield farming in the first place, and the answer to that is compound interest. And to think about the concept of why it's so attractive to compound your capital in a yield farm, we first need to look at the macroeconomic environment of today. So as many of us know, the Fed has been printing money through stimulus. This could lead to an increase in the money supply and possibly inflation. So the first problem that we face when keeping cash, for example, is inflation. So now that we know that we need to put our capital somewhere to generate returns to beat inflation, we now need to decide where to do that. And for a lot of people, the classic way to do this would be to invest in a traditional stock market. All well and good, and that's a perfectly valid strategy. However, market returns are projected to be lower in the future, even though they've averaged about 7 to 8% real return. And this article by Charles Schwab indicates that market returns might be lower in the future. So where does that leave us? Where can our money go? And enter yield farming. The number one reason why we would consider yield farming in the first place is because of high yields. For example, let's look at the latest exchange that I'll be covering in a separate video. This is Cobra Swap on the Binance Smart Chain. We can take a look at the liquidity pools where liquidity pool tokens are staked. And when we scroll down to, let's say, a blue chip pair of BNB to BUSD, you put half your assets in Binance Coin, half your assets in Binance Peg US dollar, and provide them to the pool. You're making over 13,000% APR. Of course, the problem is 99% of this is locked for now, meaning that the real APR is about 135% in farm tokens, which you can then sell and then recompound it into the pool on a daily basis. To really understand how this can generate generational wealth by following a disciplined strategy towards yield farming, we can simply do the math. Where let's say we put a relatively modest initial balance, $3,000, and we enter the interest rate of 130-ish%. We can find these kinds of returns, say on Cobra Swap, as well as many of the new projects that come out. Let's enter $3,000. And we set the interest rate at 130% yearly. We have a time horizon of 60 months or 5 years. And let's say we go about it, we just take 5 minutes every day to compound your gains. You basically take the farm token, swap half of it into BNB, for example, and swap the other half into BUSD. And then you also dollar cost average into the farming pool. And then let's say you contribute $10 a day, which is probably reasonable for an average salaried worker. So that's $300 per month because there are 30 days in a month. And then we go ahead and calculate. After 5 years, you will have $3.7 million. And that's only off of a total monthly deposit of $18,000. Now, of course, these estimates will require you to constantly look out for different farms, watch different YouTube videos, look for opportunities that will allow you to increase your weighted average yield. So let's say, for example, one of your pools drops to 80%, you might compensate by placing half of your assets from that pool into a slightly riskier 200% APR pool and then get a weighted average of say 140%. But let's see, after 1 year, you will be making about $1,800 every month. And that in many cases is enough to basically pay for your rent. And rent tends to be one of the most expensive expenses that people tend to have. And the thing is, even if you do not seek to get all the way up to $3.7 million, which I highly doubt since you're watching this video, having rental taken care of could potentially lead to much more financial breathing room for a lot of people. And then after 2 years of disciplined compounding in these kinds of high APR pools, we see that your monthly APR that you get out of your pool is close to $7,000 per month. Now that probably almost replaces a graduate level job. And if we continue doing that, we get up to $28,000 a month in the 3rd year. The crazy thing about it is that by the 4th year, at the end of the 4th year, you're making over $1 million a year. At $100,000 a month, you're making $1.2 million a year. And that just keeps growing exponentially until you reach 60 months. And very few careers or active income pursuits would provide you with income that grows so exponentially. If you look at the graph, you can really visualize this. It just goes parabolic. So we hear a lot of talk about how millennials and Generation Z will find it more difficult to purchase a house, will find it more difficult to amass wealth. Well, this is the opportunity that they have for generational wealth. And given that they have a long investment time horizon, holding these coins and stomaching the volatility is something that many could probably do. So this is really something that we should consider doing if we're already holding cryptos, or we're already into this whole thinking that, the risk reward of holding cryptocurrencies is worth it. And even if you are slightly older, we also have stablecoin pools. So banks are currently paying less than 1% interest a year, but let's see what our stablecoin pools are doing. There are pools such as these on ViperSwap. There's also Anchor Protocol on Terra. They're paying about 20% APR. So if you already have a nest egg and you put part of it into stablecoin pools, your capital technically isn't at as much risk, even though of course there's smart contract risk. But if you diversify your capital across a large number of pools, it is less likely that you would lose a significant amount through smart contract risk or rug pulls. 20% a year, that could be potentially very helpful. So now we come to a point that yield farming seems to be quite a compelling option. And of course, there are some risks we have to take note of. And that we'll be covering before we move into our strategy. The first risk that you have when yield farming is of course impermanent loss. So that happens when prices of the tokens in a pool move against each other and you end up with more of one token and less of the other token. How it works is that you always end up having more of the weaker asset. For example, if we go over to a less stable pool, if you go over to Luna Viper pool, let's say Luna goes up in value and Viper goes down in value. What the pool does is it will essentially sell your Luna to buy Viper, and you'll have more Viper coins. So that means that you're holding on to a larger quantity of the weaker asset or the weakening asset. So you can think of it as an opportunity cost compared to holding the assets. Of course, if you're following a asset allocation mix, for example, you follow the theory that you should put 50% of your cryptocurrencies into BTC and 50% into something else, into alts, then yield farming actually works perfectly for you because you always have 50% in BTC and the other half in something else. So that could be Harmony 1 coins, that could be ETH if you put it in a BTC ETH pool on Matic, lots of that on Polygon network. So in a sense, if you're indifferent to holding either coin, then impermanent loss isn't as big an issue as you might expect. So another risk, of course, is smart contract risk, and you've probably heard of things like rug pulls, or you've heard of people having their money drained from liquidity pools because of vulnerabilities in smart contract code. That is a potential risk that people might stomach when entering this liquidity mining or yield farming space. And that can be mitigated by putting small chunks of your capital across different liquidity pools so that the probability of you losing all of your capital is relatively low. So you might think, what exactly is my strategy to yield farming? Well, the strategy to yield farming is achieving a desired weighted average APR in terms of unlocked rewards, and then switching out pools when they fall below the target APR into something that's higher. If I'm targeting 130% APR, then if one of the pools falls to 80% APR, I will try to find another pool that earns 200% APR and probably move half my assets over. And then there's the issue of choosing which coin pairs you want to provide liquidity to. So on this typical yield farm, it is often the case that the farm token, in this case Viper, has pools that are highly incentivized. They're more highly incentivized rather. They get a high percentage of the pool reward. In general, however, I would not farm in a farm token pool unless the APR is really high, because it is often the case that there's little buying pressure on the token. There's little reason for people to buy the token apart from to farm it and then sell the unlocked rewards. So if the supply of the token floating in the market continues going up and demand remains stagnant, we all know what happens to the price. For example, after Snake Month, when people started swapping out their Viper from liquidity pools to put into other pools, we saw the price of Viper pretty much tank from about $1 to now 38 cents. So earlier, the first criteria was weighted average APR. The second criteria would be quality coin pairs, or at least large cap coin pairs. So I usually choose coin pairs that are less likely to dump, such as one USDC or even Aave or one BTC pools, because these coins have other use cases that are likely to result in demand for them existing at all outside of this whole farming ecosystem. The third criteria will be deposit fees. Now, lots of yield farms like to charge deposit fees on non-native pools to incentivize the farming of their farm token, but these farm tokens are eventually going to be dumped into oblivion. Statistically speaking, most of these coins don't really hold up in price, so you would probably end up losing money if you go into these 0% deposit fee pools, simply due to the fact that more incentives to sell exist than incentives to buy, and therefore selling pressure is likely to be stronger. So for example, look at this one UST pool on the piggy bank farm. You see that deposit fee is actually 4%. How long would it take you to make back that 4%? Well, that will depend. For example, if we're really doing 284% APR, we'll basically divide this by 365, and that's your daily APR, and then take 4% and divide it by that daily APR to find the number of days that it will take you to break even. For some farms, it might make sense, but if you're really putting in a lot of money into the pool and factor in the fact that these APRs might not last that long, I try to avoid pools that have large deposit fees. So some of the farms that fulfill this criteria include SushiSwap, which does not have any deposit or withdrawal fees, and all rewards are unlocked. The final policy is for farms with vesting rewards. When calculating my weighted average APR target, I only take the APR of the unlocked rewards, meaning that by conservatism, we assume that the locked rewards would be worthless by the end of the period where they're locked. So for example, if you go over to ViperSwap, you see that 95% of your tokens are actually locked until the 25th of December 2021. From then, they release at a gradual rate and people are likely to sell them and price is likely to go down further. So it's unlikely that you'll be able to recover the full value of your locked rewards. And already this has fallen from 1,300 US dollars to about $890. We don't look at the APR that's advertised over here, for example, on the Uni Viper pool. We take this and multiply it by, say, 0.05, which is 5% of the unlocked reward. That gives us an APR of 33%, so this is currently not attractive enough to us if we're targeting 130% weighted average APR. So to sum it up, first, we choose a target APR to work towards. Second, we choose quality coin pairs or large cap coin pairs that are less likely to go to zero. And third, we diversify our capital across multiple liquidity pools so that we are less at risk to a single idiosyncratic rug pull event. And fourth, we avoid deposit fees. And lastly, we only look at the APR given by unlocked rewards. Anything that's locked is simply a bonus that we can further compound into our pools later on. So I hope this has been a useful video to outline my general strategy for yield farming, as well as why you might want to get into yield farming if you have just started holding cryptocurrencies and turning them into a cash flow asset. Thanks for watching and see you in the next one.